gazing is always something sort of best avoided, but in terms of what we're seeing in the data now, I think one of the key things we expect to see is big sub-market variation to how various parts of the market, either geographically or by property type, perform over the coming year or two. So by sub-market variations, we're talking about locations that might be dominated by a certain profile of buyer. For example, the Waikato has a really high proportion of investors who have bought there in the last year or two. So will those areas be more susceptible to impacts on the investor buyers alone, potentially? Another one, for example, is new builds. What's happening in the new build space at the moment? Really strong demand amongst both investors and first home buyers, fueled by policy settings and deposit requirements which favour that as an asset type. And will we see that demand continue more so than the demand for existing investment stock? Highly likely. So the long story short there is we do expect some sub-market variation. We do expect some parts of the market to perform in a stronger way than others, and some parts to perform perhaps less strongly or actually take a bit of a hit, colloquially, value-wise. So we're looking at parts of the market, for example, development sites where they were really, really popular 12 to 18 months ago, and now those that jumped in to buy them perhaps are realising that the cost to develop or subdivide or build on that site is a lot more than they thought it was going to be. And are we seeing some signs of pressure in that sub-market already? Yes, we are. Will that correlate to price points or value levels coming down relatively quickly? I think watch this space, but perhaps one of the first sub-markets which is under some strain already. So overall, at a headline level, we expect to see value levels hold where they are for the next few months, coming into the mid of this year towards the latter half. And then we do think there's some signs forming around potential softening of that headline value level into the end of this year and through the summer period into 2023. So we expect values to end up somewhere between 2 and 5% down as a whole across the country by the end of the year into early next year. So the factors that Velocity are watching at the moment to indicate the strength of the market, obviously the number one is the OCR and interest rates. So the impact or correlation between interest rates and the market is very strong, so it has to be watched. At the moment, we would note that the interest rates have not come to the level just yet where the headwinds on values are strong enough to push them down across the board. Other factors are the noise around CCCFA, so the banking lending policy and rules, and where that might end up. Will the reviews end up in a change to that legislation which make it easier or maintain the current level of threshold to take a mortgage out? The third is the impact of the borders reopening, and what will that actually look like? Will we see a surge in internal migration, therefore a surge in demand for properties? We think unlikely at this stage. We think a lot of those that were going to buy have already bought, and so the impact on the housing market in terms of price or values may be quite negligible. Potentially some pressure points or further pressure placed on the rental market as a result. The other area that we're watching is debt to income ratios. Do they become mandated by the Reserve Bank, or do we stay in the current climate where they're used as a consideration tool for affordability but not formally mandated? If they were to come in, could be a big impact on parts of the market that are borrowing up to their threshold at the moment. And the other overall impact is just the impact of general affordability. What is going to happen in terms of employment? Do we begin to see pressure on certain sectors of the economy, which may result in pressure on overall affordability of a mortgage among parts of the economy, which may correlate to downward pressure on pricing? Not seeing that yet, but really a space to watch. So I think interesting here, there's a lot of commentary around first home buyers being potentially a really exposed group to a downturn in property prices or values, but at the moment, actually, we think there's more of a pressure or more of a potential risk on investors who have entered the market recently, who might have purchased based on a shorter term holding period, so really a capital growth based investment as opposed to a longer rental return or yield focused investment, who are now facing increasing cost by way of making sure their portfolio is adherent to healthy home standards or upgrading. They're facing impacts in terms of their tax liabilities. And when you combine all that and you take away any capital growth, potentially really vulnerable is that recently purchased investor group. We do think that would be investors are more exposed at the smaller end of town, so those that own between 2 and say 5 properties. The larger end of town, 21 plus property investors, they've typically got less of a debt burden and they typically have more of a mature long-term yield focus in their portfolios, so probably more immune to some of the shorter term impacts.